Welcome to Phillip Mastermind. My name is Kim. The Fed had lowered interest rate by 25 basis points in December to 3.5 to 3.75%, citing a combination of weakening labor market conditions and tariff-driven inflation moving further above the central bank's 2% target. This was the third rate cut of the year, bringing the cumulative reduction to 75 basis points compared with 100 basis points last year. Indeed, the recent US inflation data show CPI rising to 3.0% year-on-year in September, up from this year low of 2.3% in April. Core CPI also increased to 3% year-on-year in September from a low of 2.8% between March and May. Meanwhile, the unemployment rate has climbed notably from 4.1% in June to 4.4% in September. Additionally, the recent 43-day government shutdown disrupted economic activity, leaving an estimated 1.4 million federal employees furloughed of working without pay, which dampened both consumer and business confidence. Apart from interest rates, several other factors are important when assessing the outlook of the US equities next year. These include economic growth, corporate earnings and margins, market valuations and sentiment, geopolitics, and others. In the latest IMF World Economic Outlook projection in October 2025, the IMF forecasts US GDP growth of 2% in 2025 and 2.1% in 2026, following a 2.8% growth in 2024. Bloomberg Consensus expects S&P 500 corporate earnings to grow 14.8% in 2025 and 13.1% in 2026, after a 12.9% growth in 2024. This earnings growth has been largely driven by the Magnificent Seven, which saw earnings increase by 35% in 2025 and 20.2% in 2026, following a 29.6% growth in 2024. As of 11 December 2025, the S&P 500 is trading at 22.4 times PE, above its 10-year average, indicating that overall valuation is not particularly attractive. However, valuations appear to be supported by strong earnings in the tech sector, driven in large part by AI-related growth. As long as AI capex continues to expand, earnings momentum in this space should remain healthy. We remain cautiously optimistic. Maintaining exposure to the sector is reasonable, but not being overly overweight. One area that could potentially perform well is the emerging market equities. With the ongoing rate cut cycle, the US dollar is expected to weaken, providing a tailwind for emerging markets from a currency perspective. Historically, the dollar index has shown an inverse correlation with emerging markets performance. For instance, in 2022, aggressive Fed tightening drove the DXY higher and emerging markets equities underperformed. Conversely, from 2025 onwards, a weaker DXY has supported stronger performance in emerging markets. Within the EM space, China, Taiwan, India, and South Korea are the key markets, while the IT and financial sectors led on a sectoral basis. This indicates a well-balanced and diversified approach. In China, the 10 to 11 December Central Economic Work Conference outlined 2026 economic priorities, emphasizing tapping economic potential, balancing policy support with reform, and integrating investments in physical assets and people. Fiscal policy will remain proactive with a 4% deficit, supporting consumption, investment, tech localization, and social programs. Local government debt will also be managed orderly, while major project launches and renminbi 500 billion in policy-based financial tools are expected to accelerate. However, resolving property sector risks remain a key focus. India continues to be a consumption-driven market supported by above-average GDP growth, ongoing reforms, and central bank rate cuts. Key risks include potential rupee weakness, which could affect foreign inflows and import costs, and uncertainty surrounding the India-US trade deal, which may impact investor sentiment and export-oriented sectors. Korea and Taiwan continue to be tech-heavy markets, with a significant portion of their stock market's capitalization concentrated in semiconductor, electronics, and IT-related companies. This tech dominance means that their market performance is closely tied to global demand for technology products, innovation cycles, and trends in sectors like semiconductors, hardware, and software services. As a result, Investors in these markets gain strong exposure to the tech sector, but also face higher sensitivity to cyclical swings in the global tech demand, trade tensions, and supply chain disruptions. Finally, Malaysia, while representing a small portion of the emerging market equities, we remain constructive on the Malaysia market, supported by multiple tailwinds. Expectation of a Fed easing cycle from fourth quarter 2025 into 2026 should improve global liquidity and risk appetite across Asia. Furthermore, Malaysia's growth outlook remains supported by resilient fundamentals, firm consumption, rising investments, and ongoing structural reforms under key national blueprints. Looking further ahead, firm local institutional demand, a stronger ringgit and undemanding valuation, historical low foreign ownership of 19% should continue underpin an attractive risk-reward backdrop. In summary, our recommended approach is a barbell strategy, combining growth and defensive exposure. This allows participation in high-growth opportunities while maintaining stability and downside protection through defensive assets, achieving a balanced risk-return profile. A noteworthy avenue for investors seeking diversification in their portfolio is through Phillip Capital Malaysia. Phillip Capital Malaysia offers multiple prime managed account services managed by professional fund managers. By leveraging on Phillip Capital Malaysia's prime managed account services, investors can enhance their resiliency, optimize portfolio performance, and navigate the complexities of the market with confidence. Apart from our inaugural prime managed account services, we also offer unit trust funds, PGWA, that could cater to different investors' needs. That's all for today. Stay tuned for our next Phillip Mastermind. This update is brought to you by Phillip Capital, your partner in finance.